Hey everyone, welcome back to another tax tip. I'm Joshua Ferguson with Ferguson Financial Solutions. And this week, we are going to start part one of a six-part series on entity classification. So when forming an entity, there are a lot of questions that come up. So which one do I choose? What if I change my mind? How do I handle going out of business? Which one will protect me in a lawsuit? What if I get married? What if I get divorced? What if my partner doesn't pay? All of these things are very real and valid questions. So I'm here to help you navigate them. So like I said, this is part one of a six-part series. We will go over six different entity types. So they are sole proprietors, LLCs, partnerships, corporations, subchapter S corporations, and nonprofits. So without further ado, let's get started with sole proprietors. So a sole proprietor is the most common business structure. This type has only one owner, and it's taxed at the owner's individual tax rate. Profits and losses are reported on Schedule C of Form 1040. The benefits of a sole proprietor are it's easy to set up, it's relatively inexpensive, it's recognized in all 50 states, and there's less regulation than other tax structures. Now, sole proprietors have their drawbacks. It's the highest tax rate of any other entity type. So if you are a sole proprietor, you will pay self-employment tax of 15.3% plus whatever your individual tax rate is. For example, if you're in the 22% tax bracket, you will pay 37.3% of your earnings, of your self-employed earnings in taxes. That's very high. Another drawback to sole proprietorship is there's no liability protection. You are the owner of the sole proprietorship is personally responsible for everything in the business. And a third drawback is it increases your chance of an audit. There's a higher chance of IRS scrutiny for Schedule C income. Thank you for joining for us for part one of entity classification. We'll see you next week for part two, where we discuss LLCs.